I'm Sebastian St. James. Today I will tell you how the S&P 500 makes you rich and how you could earn $42,759,874 just by investing $1,000. This is investment performance over just 1 year. What are we comparing, Sebastian? If you invested $1,000 over 1 year, we'll see what each of these asset classes would return to us. All of these are total return. That means including dividends. On the S&P 500, you would have made $1,209. Slightly lower if you converted that into Australian dollars. The ASX 200 plus franking credits, you'd get back slightly less than the US. Gold is next. Money in the bank. If you invested $1,000 in bonds for an entire year, you'd just get back $2. I wouldn't even cross the street for that. Over 5 years, well, green is out in front. Who is green? Green is the S&P 500 converted to Australian dollars. And I did notice earlier on, purple actually did quite well, and purple is physical gold. Interesting. Down the bottom, the two losers, red and blue, which is cash in the bank and bonds. If you invested $1,000 over 5 years, you get back from the S&P 500 total return, converted to Australian dollars, $1,892. You've almost doubled your money in 5 years. Slightly lower in the US fund. Gold, surprisingly, has jumped up to $1,700 return. Not bad, gold. The ASX, including franking credits, $1,500. Once again, cash and bonds right down the bottom. Look at bonds. $21 return for investing in 5 years. That is disgusting. There is a problem with investing, and that problem is lack of data. If you want to see the return of the ASX 200, you can just Google it. Look at the max data they give you. That goes back to 2007. That is 15 years worth of data. But that graph is a lie. If you invested in the ASX 200, that is not what you'd get back because you get dividends as well. But hunting down the total return of the ASX, which is the stock price plus the dividends, is harder than you'd think. Much harder. Throw it into Google, it will tell you the 1 year's return. That's it, 1 year. That's all you get. 1 year, definitely not enough, so I went to some specialist financial websites. Here's the first one that's recommended. It goes back only to 2019, which is 4 years ago. That's it, that's all the data you're getting. The next major website stops at 2018. Just 5 years of data. Oh, what's the best asset class for me to invest in? I don't know. 5 years tells me absolutely nothing. And this is the data you need most. This is total return. It's really the only data you need. With lack of data comes lack of trust. Here, I'll show you what I mean. Elk is my latest channel member, and one of the perks of becoming a channel member is you get to see what you really look like. This is Elk with 2 Ks. With an elk. It was his destiny. Elk runs an investment fund. Let me bring that up for you. Here it is, Buck the Trend Fund. The 5-year return of the ASX 200, 10.9%. The Buck the Trend Fund, 15.9%. Right. Clearly, Buck the Trend has actually outperformed the ASX. Problem solved by Buck the Trend, right? Whoa, hold your elks. Any investment fund can have a few lucky years. Perhaps the market conditions over the last few years have been perfect for their proprietary system, but you're going to find over the longer term it actually underperforms. And with only 5 years worth of performance data, lack of data means lack of confidence. So personally, I'm sticking with the ASX 200. What is my next option? This is the Wazza and Chuck Fund. Never heard of it. Over the last 75 years, the ASX 200 has an annualised return of 10.9%. The W&C Fund, 15.9%. Same return as the last fund, but they've got 75 years worth of data, and that is enough data for me to gain some confidence in them. They've traded through good markets and through bad, so 75 years is enough time for their system to be proven. So, Wazza and Chuck, who are these randos anyway? Just as I thought, never heard of them. So, if I'm trying to decide whether I want to invest in the US or the Australian stock market, cash or bonds, and do I actually want gold, is that a reasonable safety net? I can only make an informed decision if I have decades worth of data, and often that data is impossible to come by. And that is the purpose of this video, giving you the most data humanly possible of the S&P 500. And just how long will blow your mind. This is our investment returns that we've been looking at over the last 10 years. Green is clearly winning. Who is green? That's the S&P 500 total return in Australian dollars. Well done. If you invested $1,000 10 years ago, you'd get back from the Australian S&P 500 fund $4,299. You've more than quadrupled your money in just 10 years. That's incredibly impressive. $1,000 vested in the Australian market plus franking credits would give you $2,563, which is almost half. Okay, not so good. Bonds perform dismally and cash right down the very bottom. Look at the difference. $1,200 for cash, stocks $4,299. Yeah, no comparison. I'm currently making a video for Elmo about the sequence of return risk. Let's say you retired right here, and then the next day the stock market crashes. Oh no, a disaster! It wipes out half your savings and it takes years to recover. What a massive risk, and that is sequence of return risk. To find out how likely that is to happen, to calculate the probability, I need the most amount of data possible, right back to when dinosaurs ruled the Earth. To get that data, over the last few days, I have undertaken an intensive research project to reconstruct the S&P 500 data. That's right, I said reconstruct. Actually, it's even better. I've reconstructed the data of the S&P 500 total returns. That means including dividends. And yes, that is a total return that was basically impossible to get any long-term data on. The data itself is so impressive, I've temporarily interrupted the sequence of return video to present to you my findings. So, how impressive is it? Let's compare it to the ASX 200. Give me the total return. Actually, give me the total return plus franking credits. And here's the data over 10.6 years. Why 10.6 years, Sebastian? In particular, it's because I need the franking credits. In Australia, that is your true total return. And by adding in the franking credits, virtually nobody has that data. The most you can get publicly is 10 years. So, why have I got 10.6 years? Because I saved my history, and over time I'll get more and more data, but publicly there'll only be 10 years available. So let's write that down. The historical data available for the ASX plus dividends plus franking credits is 10.6 years. Is that enough data for me to calculate sequence of return risk on? No, definitely not. Oh, I just got a thanks from Harley Russell. Thank you very much, Harley. That was very nice of you. In the data I've shown you so far, currently we've gone back 10 years. But I can't go back any further because the ASX 200 tops out at 10.6 years. So to go back further, ASX 200 plus franking credits, out, you must go. Woo! When it comes to Australian bonds, I have more data, but it's specific to the 2-year bond. And it's not Australian bonds in general, which means bonds, out, you must go. Yes! And Australian bonds, the entire market, is 10.4 years. Oh, I got lots of thanks from Elmo. From retire early with just dividends, diversification, get rid of your boss. Oh, that sounds like a good idea. Thank you very much, Elmo. That I appreciate. Elmo is steadily going right through my entire back catalogue, and when he's finished, I get to go on holidays, and Elmo can take over my channel. I can hardly wait. Over the last 15 years, well, we have fewer investments now, don't we? The winner is orange. Orange is the S&P 500 converted to Australian dollars. Down the bottom in blue, well, that is high interest savings account. If you've ever wondered whether cash or shares perform better, well, there's your answer. If you invested $1,000 15 years ago in the S&P 500 converted to Australian dollars, you would have got $7,045. That's a 700% return in just 15 years. That is impressive. Gold, I would have got $2,000. Cash in the bank, 1.5. Okay. If I invested in 20 years, the result's a little closer. Red is the leader, which is the S&P 500 total return, not in Australian dollars. Notice that. If I invested $1,000 20 years ago, I would have got back $6,691 from the S&P 500. Gold, a reasonable 5.2 thousand. Yeah, impressive. Cash, 1.8. Prior to this video, I had lots of data on the S&P 500 total return, but it had an immovable date. And that was January 1988. That's as far as my data went back, and there was no available sources beyond that. Let's slip that into context. The S&P 500 plus dividends, that's what total return is, goes back 35 years, which is a lot better than the others, but still not good enough. Let's have a look at all the data, the total return data for the S&P 500, and see what the entire thing looks like. Here it is, 35.5 years. This point here is the start of all the publicly available data for the S&P 500 total return. Orange is in the top, which is the one converted to Australian dollars. Cash is down the bottom, which is what we'd expect, but look at gold. It's right down the bottom. In the previous graph, gold did amazingly over 20 years. Take it back to 35.5 years. No, gold is pathetic. If you invested $1,000 35.5 years ago, you would have got back $38,121. Impressive. That's from the S&P 500 converted to Australian dollars. Cash was $4,000. Wow. And gold actually underperformed cash at 4.25. Yeah. So over the last 35 years, you would have been better off sticking your money in the bank than holding gold. But gold is a protective asset. I need it in case the market crashes. Yes, and so is cash. And the cash has done just as good and without all the risk. Oh, I've just got a thanks and a question from Phil. Thank you very much, Phil. That was a lovely surprise. The S&P 500 total return caps out at 35.5 years, but apparently for some people that's not long enough. So, using my supreme powers as a data scientist, I said, if the index does not have enough data, I must build a brand new index. And it was so. What I have is the data of the S&P 500 without the dividends. If only I could find the raw data of the dividends going back into history, using special techniques which I've developed, I could mash the two together and reformulate the total return index. So it works like this. The S&P 500 total return, we have real data going forward. I want to continue that back into time by reconstructing the data. After contacting all my data brokers and carefully following one lead after another, I finally found it, the raw dividend data. Having the raw dividend data is one thing, but being able to take that data and carefully reconstructing the S&P 500 total return index back in time and have that actually line up and make sense required a massive feat of skill and time. And these are the steps I had to undertake. Step 1, convert the dates to a standard format. The dates were in a text format that really made no sense at all, so I had to write myself a script that would pick apart the date components and reassemble it into a proper date. Step 2, understand what the dividend data actually was saying. This is a snapshot of the data I've got. A column of dividends with, well, just a bunch of numbers. What does that mean, Sebastian? Are those figures a percentage, or are they a total payout in millions of dollars? That I had to decide. Step 3, convert the dividends to percentage growth between periods. But what period? The period here is monthly. My previous total return data was all daily, but to go back and reconstruct the index, I've had to settle for month by month. Step 4, add in the S&P 500 price data without the dividends. Fortunately, that is data I've already got. And the last step is to scale the results to match the existing S&P 500 total return data. And here it is, the big reveal. This is the S&P 500 total return data going back before publicly available data, seen with your very own eyes. This is 41.2 years worth of data. And approximately here is the start of the reconstructed data. To the right is the publicly available index. To the left is the same index but reconstructed from the raw data of the dividends. If you invested $1,000 41.2 years ago, you would have got back $184,000. Wow. And that's the S&P 500 in Australian dollars. In US dollars, considerably less. Yeah, that's fascinating. Cash in the bank would have given you $8,000. Gold, $8,000 as well. Yeah. And there you go. You're seeing investment returns for the S&P 500 total return, including dividends, of data that is not available to the general public. I know, it's like seeing the Dead Sea Scrolls come back to life. Oh, I just got a thanks from Gaurav. And the money from his thanks he wants to put towards Ting's question. Thank you very much, Gaurav. That was an amazing surprise. This question has become one of the most fascinating questions of all time. Nine days ago, the question was asked by Ting. I did a video which showed how much you get if you own property in Australia. Ting would like to see the same data, but with all the costs taken out. At this point, the question was added to my queue and would have been lost in the queue. But Ting then added $10 to it, which bumped it right up the queue. Gaurav comes along and says, no, this question really needs to be made. And this video definitely will be made in just a few videos' time, and I'm really looking forward to it. It's now time to say goodbye to the S&P 500 converted to Australian dollars. Oh, why is that? The S&P 500 plus dividends converted to Australian dollars lasted 43.5 years. No, why is this data going? I want the data to stay. Well, so do I, but the problem is that the currency conversion data between the US dollar and the Australian dollar has stopped. Hence, I can't convert the American dollars to Australian dollars. So out that index must go. But also, because we're going beyond the 40-year mark, we've got to say goodbye to the high-interest savings account, that's cash, and to gold, because the gold was actually also converted to Australian dollars. All right, how much data did we have? Cash was 41.2 years. Gold was 43.6 years. Everybody's leaving me. That leaves us just with the S&P 500 total return. But the question is, when did the S&P 500 itself actually start? On Monday, March 4, 1957, the index was expanded to its current 500 companies. That was before I was even born. The question is, can I actually graph the entire data set right back to the very beginning, the day that the S&P 500 was created? Better yet, can I do it including dividends? Oh, I just got a new channel member. Hang on, Sebastian, we've seen your latest channel member. This is true, but 5 seconds before closing the script on this video, somebody else joined. This is Mystery, and she's my latest channel member. Oh, what are you wearing, Mystery? Oh, you're dressed as a detective. Mystery's off to solve a few crimes, so if you'd like to know what you look like in my world, just hit the join button below. Here is a pivotal moment in your life, like the time you got your driving license, like the time you got married, like the time you discovered black jelly beans are the best. Here is the entire history of the S&P 500 back to the very day it was created, including dividends. Whoa, here it is, the entire 66.4 years, and that is exactly where the S&P 500 was created. What this graph is really showing me is the power of compounding interest. It's basically flat, 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 and the last half, whoop, it scoops up. That is exponential growth. Isn't that magnificent? You can officially say you've seen the entire history of the S&P 500, including dividends. One day your grandchildren will ask you about this day. Oh, I just got a thanks, and this thanks requires a fanfare. Oh, it's from Elmo. Thanks, SSJ. Thank you very much, Elmo. A huge, huge thanks to you. Elmo is currently waiting for the sequence of return risk video. That video is partly made already, but it's in the process of collecting the data for Elmo's video that it led to this video. Interesting. So, what is the return of the entire history of the S&P 500 back to the very day it was created, but including dividends? If you invested $1,000 on that day, today you would have got back $1,084,959. I'm about to tell you something that will blow your mind. I have data even before the S&P 500 was created. Mind blown. Sebastian, how is this even possible? My understanding is that one day the bull and the bear from Wall Street actually collided and bang, the S&P 500 was created, and there's nothing before that. That's just like asking, what was before the beginning of the universe? Of course, there was nothing. Well, that story is fact, but there is another. In 1957, the S&P 500 was created. The question is, if we want to see what's gone on before that, when did the S&P, the Standard & Poor's, actually form? In 1941, Poor's Publishing merged with Standard Statistics Company to form Standard & Poor's. S meets P. They become the S&P, so there was an index before the S&P 500, it just didn't contain 500 stocks. Can I take you back to the very day that Standard & Poor's got together to form the S&P? No, I can't. We don't know the actual day, but I can take you back to the beginning of January in that year. So we've definitely got you covered. And here it is, 82.6 years of data. That there is when Standard & Poor's was formed, the actual company which the S&P 500 is named after. If you invested $1,000 in that year, today you'd have $14,499,995. That is not as ridiculous as it might sound. My mother is actually older than 82.6 years, and she forgot to invest $1,000. I know, she's wasted her entire life. My data for the American stock market total return, which I've had to personally reconstruct before 1988 from raw data, actually precedes the S&P 500. So if there wasn't 500 stocks, how many were there? Well, from 1926 onwards, it developed a 90 stock index which was computed daily. 90 stocks, but that represented the entire American stock market. The question is, can I go back to the day that that index was created? No, I can't. My data ends at January 1928. Oh, I'm 2 years short. We'll call that the standard 90, plus I've added in the dividends. I've reconstructed the total return index right back to 95.6 years. And here it is. That is almost more data than a supercomputer can contain. The question is, if you invested $1,000 at January 1928, how much would you have today? You would have today $42,759,874. Wow! Yes, please, sign me up. Oh, I just got a thanks. Traynor watches my videos mostly on TV. So Traynor, this is a nice close-up for you. Boo! He couldn't find the thanks button on either device, so imagining his phone was an iPhone, so instead he went through a browser and found it there. Thank you very much, Traynor. Your thanks has pushed your question further up the queue. But now I've got more data than God. What can I do with it? This data includes the 1929 stock market crash. It includes the boom of the last few decades. Anything that could happen to the stock market is most likely in that data. So using that data, I can calculate anything. The 4% rule, the bucket system, 100% stocks. What is the likelihood of that outperforming or failing dismally? Using that data, I can simulate and let you know. You now know everything about the S&P 500, but perhaps you prefer to invest in property. Don't buy property in Australia before watching this video here. Or if you've seen that, click here.